Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with this podcast is to sit down with top market practitioners, learn how they are approaching the markets, try to understand their perspective, their tools, their routines, the techniques that they use every trading day, get a sense of how they are observing and interpreting the current market environment, some of the key indicators, charts, and insights that they're paying attention to in the days and weeks and months to come. Great guest today, Callum Thomas. Callum is the head of research and founder of Top Down Charts. He's based in New Zealand, so my 9-year-old son loved the fact that I was interviewing someone from the future. It was Monday evening, Monday afternoon in Seattle. I'm talking to someone who's Tuesday morning in New Zealand, so my son got a great kick out of that. Time zone, unique situation aside, I hope you find it's an engaging discussion with Callum. Callum's work I followed for a number of years. I found Callum through social media. Ended up connecting virtually and have been randomly engaged with him over the years. So it was really fun to actually meet him virtually, to ask him questions about his process and how he's approaching things. Great time to talk macro, of course, because, in this particular week here, recording this at the end of July of 2025, it's Fed week, it's the middle of earnings season, we've got more economic data coming out, particularly inflation-related data. So it was really cool to talk with Callum about some of the, macro, I think, themes that are top of mind here. He makes the argument the Fed should actually be thinking more about raising rates than lowering rates. He talked about expectations for the Fed here in the next couple meetings and going forward. Talked about credit spreads a great deal. The narrowing of spreads represents a lot of optimism in the fixed income markets and what that could mean. Talk about seasonality, which is actually really interesting, particularly with the VIX. I often think about seasonality in terms of the S&P, but I liked, his sort of way of thinking about it, which was thinking about seasonality in the VIX. And the VIX usually spikes in August and September, and that usually relates to a sell-off in equities and other risk assets. But I thought his chart that you'll see if you're watching the video version of this podcast, I think you'll find very interesting, thinking about what that might represent in the months to come. Talked a lot about valuations, and I really appreciated his take on that, thinking about the liquidity and speculation that has driven equities, cryptocurrencies like Bitcoin, hard assets like gold, generally at or near new all-time highs. But talked about, and I think this was a key point, the relationship between valuations, but also the technicals and the macroeconomic conditions. End of the day, Callum at the end, really is more of a technical analyst than anything. He analyzes a lot of macro indicators, but all through charts. And that's why I really have found his perspective to be, very, very interesting. Reminds me of other macro strategists like Tony Dwyer, had an incredible career at Canaccord Genuity. Gina Martin Adams, head of Bloomberg Intelligence. These are macro strategists, but I think of them as more technicians than anything, because they are applying best practices of technical analysis, thinking about extremes and inflection points, which are technical concepts, but applying them to, macroeconomic data. So please enjoy this interview with Callum Thomas of Top Down Charts. So I'm super excited to be sitting down today with Callum Thomas. Callum, I've followed your work virtually for so long, and it is really cool. It's been great to navigate, help sort of follow your thoughts as the markets have evolved over a number of years, but really cool to sit down with you virtually today. So thanks for coming on the show.
Yeah, looking forward to it.
So I feel like our cup runneth over with things to talk about right now. There's so much happening, right? But let's start, if we could, with process. I mean, I've followed your work for some time. I know not everyone has, probably maybe as closely as I have. So can you start high level with us? How would you describe your process? What does your day look like as you're evaluating market conditions? What's the Callum Thomas process look like?
Yeah, I mean, in terms of the day, I guess every day is a little bit different. The day is kind of dictated by the publishing cycle that I have. On a Monday, I'm putting out the Global Markets Monitor. So I'm, looking at every market, every asset class, and seeing, what's the key price developments there, and pulling out any key market themes. On a Tuesday, I'm kind of just doing a bit of business stuff, making sure that everything's running smoothly, because it's when you're running a research business, it's you got to be winning and figuring out two things, not just how to make sure that you're figuring out what's coming next to markets and helping your clients, but also making sure that everything's running smoothly on the business front. Wednesday, I'll be starting to pull together things for the report that I put out on Friday, and Thursday, sort of gradually stepping that up until Friday's just a frenzy of activity around that report, which I call the weekly macro themes report. It's but it's a mix of investment ideas, risks. So what kind of risks are coming onto the horizon? Macro trends that are investment relevant, because I only really care about economics and macro as it pertains to the impact on markets, and asset allocation issues, like new research on that, because it is the service that I'm running is originally designed for multi-asset investors, because that's my background. Prior to going out and starting a research firm, I was working in investment management in a multi-asset team, and basically helping with their process. And so now it's instead of one employer, I've got multiple employers. But with that, it's I guess probably the relevant point is how do I pull together investment ideas for that report? And to me, it's it's a process of putting together puzzles. And so if you only look at one puzzle piece, like whether it be sentiment, technicals, valuations, etc., it's quite rare that you can actually form the whole picture from just one puzzle piece. Maybe you can sometimes, but maybe you can with two puzzle pieces, or three. You're probably getting there, and so from my point of view, it's about pragmatism, saying I'm pretty happy to look at valuations differently, technicals, sentiment, positioning flows, macro, financial conditions, and even sometimes qualitative, anecdotal stuff. Anything that helps build out that picture, and one, forming the picture, but then also getting to the point where your conviction level is rising, because the more conviction, the more evidence you can put behind that idea, the more likely it is that you're going to be going out there and saying, this is a great idea, this is I've got strong conviction in this, and the more likely it is that your clients are like, oh yep, that makes sense. Because if you're only if it's like, well, this market's broken out, let's buy it, maybe that's enough for some people, but if it's like, this market's broken out and it's cheap, and financial conditions are supportive, the fundamental indicators are turning up, then it becomes a high conviction idea. And hopefully the best ideas in that sense where they're high conviction, and not everybody is yet on board. You have the sort of spectrum of conviction level and consensus level, and because if you turn up and say, I've got high conviction in this idea, and everybody else has as well, and everybody already knows about it, then
Fair point. Well, but I love what you described, Callum, is describing it as a spectrum, because I feel like a lot of people sort of treat financial analysis as you always have a high conviction, 100% probable idea that you're going on with. And I think you're laying it out much more realistically, which is there's a spectrum of high conviction to low conviction. There's a spectrum of consensus to not consensus, and thinking about where your views are in that spectrum is probably pretty healthy. You mentioned sort of the different puzzle pieces that you combine, and I would love to bring up a quick graphic that you have on your Substack page, sort of combine. I mean, I think this is sort of the puzzle piece, argument in visual format. And if people aren't seeing this, charts plus ideas plus big picture equals insight. So as you know, Callum, my background is in technical analysis and behavioral finance. So investor behavior and decision-making and trends and momentum. So can you talk about the chart component to your process, how that relates to the others, particularly when they're not in agreement? Because as you said, sometimes it feels like everything fits together beautifully. Sometimes part of this will look, more encouraging. part of it probably looks a little more discouraging. How do you resolve, or how do you work through, disagreement between different parts of your, different pillars in your process?
Mm. Yeah, well, I mean, I guess one point of clarification is that like pretty much everything that I look at in terms of the puzzle pieces are charts. So like it might be a stock chart with a trend line or a trend indicator, or it might
Yeah,
be a chart of a valuation indicator. Um, and then, and that by itself is an interesting part because, if you think about valuation indicators, they're typically contrarian indicators. So,
yeah,
when the thing's very overvalued, that's saying, it's at risk of falling because, and then when the thing's very, very cheap, especially when it gets to extremely cheap levels, then the probability of an increase is good. But then you look at a trend indicator, so like price versus 200-day moving average, just as a simple one,
sure.
you know, um, when things are very overvalued, they're probably going to be in a good uptrend. When things are very cheap, you're probably still in the middle of a downtrend.
Yeah,
The trend indicators haven't turned, but um, and so there's kind of like a little bit of a twilight moment where those two specific indicators are going to be just mechanically kind of in disagreement. But
sure.
when they do line up, because they eventually will, like, the market falls, gets very cheap, and then starts to rebound, and then at a certain point your moving average crosses over, your trend indicators are kind of activated, and that's the safest point. Like, if you think about valuation indicators, the pushback's always like, well, yeah, but what if it's a value trap?
Yeah,
Or it's valuations don't matter because it's in an uptrend. There's other factors, all these stories that we tell, but it's when to avoid value trap is you find the thing that's cheap, and then you wait for the trend indicator to kind of tick up. It's the dangerous point is when it's cheap and going down, because
yeah,
it'll get cheaper and cheaper and cheaper. And the same thing when it's expensive, because then especially professional investors, you are your performance is tracked against peers and the benchmark, and if you're sitting underweight equities and because it's expensive, it's getting more expensive, but there's all the stories that we're telling, and we've got a bubble going on, monetary stuff going, trends going up. That's a dangerous point to be kind of underweight going against it. But when it
sure.
turns the corner, that's kind of like the point of maximum risk, to be still long, and the maximum
Yeah.
opportunities cheap and turns up. Yeah.
I love that description, Callum, I think that's what probably drew me to your work originally. Is I feel like you look at a lot of themes like volatility, like valuations, etc., with a very technical lens. You look at it with the
Mm,
the view of a
yeah.
chartist, I would argue, and that's probably why a
Mm,
lot of your takeaways really resonate, because it's definitely the toolkit that I think
mm.
makes sense. It's so funny
That's a good
talking
point.
about
Yeah.
the value traps
To
and
think
reading
about that.
charts. Oh, go ahead.
Sorry to interrupt. It's
No,
just
good.
think, you just made me think. It kind of actually maps to the sequence of bosses, or mentors that I had, through my time in
Yeah.
investment management. The first one
Okay.
was quite fundamental focus, and then another one was quite technical
Ah,
focus, and sort of it's like, all right, and kind of seeing the strengths and weaknesses of each approach, and then that kind of like, oh, maybe I'll just take the best of both.
well, I think honestly, Calum, I think
Yeah.
that's what shapes us as investors. It's the mentors we work with, it's the
Mm,
shops we're at and the cultures there, it's
mm,
the tools and techniques that people use, probably the things that work very well. I know I've learned from techniques and approaches that have not worked very well. And
mm,
that sort of shapes who you are. We should have
mm,
started with this, Colin, and we'll come back to a lot of discussions about the markets. But in case people have not picked up by from your accent, you are based in New Zealand. Your experiences with some of the mentors that you talked about, those are all in financial institutions in New Zealand. Is that correct?
and Australia. So
In
yeah,
Australia. And
yeah,
what
yeah,
sort of shops, what sort of, I mean, just give us the quick summary. What
yes.
types of, money managers or shops were you working at before you sort of launched top down charts?
Yep. Yeah. Well, the first job out of university was at the New Zealand Stock Exchange, which was kind of interesting,
No
just working
kidding.
at the coalface of things, the
Cool.
infrastructure of markets. So that was
Yeah.
quite, yeah. And so after NZX, I joined AXA Global Investors. It's a French-based company that had operations down here. And then an Australian-based company, AMP, took that took the local operations for that company over. I got brought across to Australia, and so that was like managing pension company kind of funds or
Okay.
401k kind of funds, balance funds. Just trying to think of the equivalent type of funds over in your neck of the woods.
Sure.
But yeah, multi-asset funds and the sort of the core goal of those types of funds were, well, helping investors save for retirement, with the different sort of, a balanced fund, conservative funds, etc.
Yeah.
And it was interesting too because kind of to go on a tangent, at my time there, like there was sort of a transition between, um, you know, let's put these funds together that have a strategic asset allocation benchmark, and you tilt around that benchmark, and that's kind of like where I gravitated to the dynamic asset allocation side of things, going
Sure.
underweight. Um, but then there was sort of like a transition between benchmark to, actually investors don't really care about a benchmark, and you underperforming the benchmark if the benchmark's gone negative. And so they actually care about absolute returns. So it was kind of like a shift towards, CPI plus kind of
Yeah.
mandates, which still employing all the same principles, but I guess even more emphasis on, that dynamic outlook on risk and return. So, and especially on the risk side of things, it's really going back to the first principles of don't lose money, and also, try and bank a bit of, the upside, so that when you do get the downside, you're coming from a higher base rather than, staying too close to the risk aversion side of things.
Yes.
Mm,
I spent a number of years at Fidelity, and I feel like in a lot of ways that really it definitely helped me think a lot more about the risk side, which
mm,
I feel like a lot of individual investors struggle to sort of process and
mm,
plan
yep.
effectively for. And especially
Mm,
working with bond investors, with high yield investors, tended to be
mm,
very focused on risk. And I think for me that really helped me
yep.
learn, the benefits of focusing on not just
Mm,
hitting the next home run, as we would say, or finding
mm,
the
yeah.
next 10 bagger, however you want to describe
Mm,
the next winning stock, but also thinking about how much you're putting at risk, thinking about bet sizing, thinking about
mm,
portfolio construction. And I pick up on a lot of that
mm,
sort of
yeah.
mentality in your work as well,
Mm.
Callum. We
Yeah,
you
and
you
that's
talk Yeah, good.
a very good point, because I think investors do need to think, especially the individual investors, like what kind of sets apart institutional investing from individual investing is, um, institutional investors, because of the governance requirements, you have to have risk management process. You have to
Yeah.
have kind of like a clear goals and objectives, and then
Yeah.
you also have to have basically a process, because you need to also communicate like how to your clients, like how are we doing this, and so I think a lot of individual investors would do well to think about those three things, risk management frameworks, what are they actually trying to achieve in terms of the goals and objective, and what are their process, because you need to have some kind of repeatable, reliable way of looking at things, rather than just chasing the next hot thing. Otherwise, you don't learn anything from doing that. Over
Yeah.
time, you can, if you have a process over time, you can, it's not going to work all the time, but you
Yeah.
can fix it and make it better. And,
Yes.
as part of that journey, you get better over time. And so you're compounding your investments, but you're also compounding your actual, mental infrastructure that you use to do the investing.
I love that. Callum, I wish more investors were, actively trying to upgrade their awareness of the markets and the tools and techniques that they use. I think you're doing a great job trying to encourage people to do so with a lot of the work that you do. I have to ask, you mentioned starting your first job in the industry was on the floor of the New Zealand Stock Exchange. What
Yep.
what memory stands out from that period, or any lessons learned from time on the floor? I feel like the number of people able
Yep.
to talk about those experiences, unfortunately, are shrinking because physical
Yeah.
floors are no longer the norm. But what was that
Well,
like? Any memories of that period?
I mean, the floor at that stage was like, just a carpeted floor, like, that with a bunch of electronic computers. So like, I don't, I wasn't there early enough to be, on the chalkboard floors,
Yeah, yeah,
unfortunately. But when I was there, it's all electronic, like I'm talking about 2008.
yeah.
But
Sure, sure.
that by itself being being 2008 was,
Fascinating.
seeing unfold, um, you know, like seeing, projects get pulled because the investment bank partners that you had on that project, new exchange project were getting laid off,
Yeah,
because of all the stuff that was going on in the world at that stage.
yeah.
So that was quite because I was working in corporate strategy there, so like the actual business of the exchange,
Oh wow.
and that. So that was, yeah, that was a very interesting perspective to have, for sure.
I feel like anyone that has navigated through that financial
Mm,
crisis area, so that 2007 to 2009, I feel like we all have visible or invisible
mm,
scars somewhere from that experience. So I'm glad we all made it through in some way.
mm,
Let's pivot, if we could,
yeah.
Callum, and talk a little bit about the current market
Mm,
environment. You mentioned valuations. You mentioned, just thinking timing wise
mm,
about, when things are undervalued or overvalued. It's hard to not describe the current market environment as overvalued by a lot of metrics, I would imagine. However, the trend continues to go higher. And in one of your recent pieces, I think this was your weekly piece that I caught this. You said valuations, even extremes, are not enough by themselves to get max bearish on stocks versus bonds. You need technicals to turn, not yet, and also bad macro, also no. So it feels like what I'm inferring
mm.
from your recent work, valuations pretty elevated, but strong technicals, constructive macro conditions. So overall, we're still kind of in a green light, I guess, market wise. How would you think about valuations and other metrics here in July of 2025?
Yeah, yeah, exactly. So if we look at, and this is like the high level, the big lever to pull on asset allocations is your stock versus bonds.
Yeah.
And stocks here, they're expensive versus your own history. Bonds are cheap, and then stocks are expensive versus bonds. And so that sort of sets an underlying bias or expectation.
Mhm.
It makes you think, okay, over so the medium term, we expect valuations to, make their voice heard. And so therefore, if we're not concerned with the short term stuff, then we probably already want to be factoring that in, that because the risks are to the downside for stocks and the risks is to the upside for bonds. But if you think about all of the time, most of the times in history where bonds have outperformed stocks,
Mhm.
most of the time that's during a recession. So the time where bonds outperform stocks most reliably is when stocks go down. Kind of makes sense.
Yeah.
And so from a technical standpoint, again, it comes back to what we were talking about. If you look at the stock bond ratio, it's in a nice uptrend. It got a bit shaken around in April,
Yeah.
but if anything, it's just that trend is still very much intact. And then on the macro side of things, if you want to keep it really simple, for the stock bond ratio to roll over instead of just keeping on going up, you basically need the unemployment rate to start going up. So if you
Yeah.
invert the unemployment rate overlaid on that chart, it's pretty much it makes it's one of those charts, and people sometimes accuse you of you putting two lines on a chart and saying, "Oh, you're just playing around with axes," but it's one of those ones where um, the economic logic behind it is very sound. And
Yeah.
that's something that you should be thinking about. Okay, because it's good to put two lines on a chart, because it helps you kind of say, well, this one usually goes up when this one goes up, and it's sort of, that pattern's breaking down, or this one's pointing to a change in that one, or I have a view on this line.
Yeah.
But you have to have, confidence that there is economic logic behind it. That in this case, if the unemployment rate goes up, well, that means the economy's going into tailspin, going down off the rails. Bonds usually perform in that situation, as long as it's like, disinflationary or deflationary. And stocks, well, over the long run, the most reliable thing to make the stock market go down or to have a bear market is a recession, or prolonged period of stocks going down. So, the economic logic there makes sense. And so, if you look at the economic data, there is some mixed signals, but overall it looks pretty resilient, and the trend is still up. So even though the valuation thing says, let's begin to think about risk management, let's sharpen the focus on that, it's not, it's not something where you can form a high conviction view just yet.
Yeah. Yeah. I think that's well said, Callum. And I think you made that point when things are very undervalued, sort of we always call about the falling knife challenge, right? It can be very tempting to buy something very undervalued. But I've learned when price goes down a lot, it's usually going down for a reason. And now we have the opposite situation, right? It's like, do you want to be selling or fading a market that is showing such resilience and so much optimism? I'd probably be patiently waiting for some sign of negativity, but I haven't seen a lot of those either in my own work.
And then it's dangerous too to I think I don't know if it was Soros or Druckenmiller, but might have been Druckenmiller said, and I've found this to be true, is it's kind of dangerous to get bearish on the stock. It does kind of play with your mind, and especially like, and you got to be wary of the psychological factor, and, this getting bearish or taking the short side, it really does take a different sort of mindset. And once you kind of get stuck in that mindset, it can be, can really color your biases. And, there's a lot of fighting the market, and, that can be quite self-destructive in certain regimes.
Yeah. Yeah. No, I think that's well said. And I think probably one of the things I appreciate about your work, Colin, is it is very much, I always tell people that you want to get away from an emotion-based investment process and get to a more evidence-based investment process and focus on the message the markets are providing back to us. I think you do a really good job of illustrating that in your work every week. So tell me this, it's Fed week here in the US. We've got the August or July-August Fed meeting happening.
Yeah.
The market really not pricing in any, rate cuts likely at this meeting, but, are starting to price in potential rate cuts at the next meeting coming up in September. In your recent work, what I've been reading, you've been talking more about, maybe rate hikes would make more sense in this environment. Can you talk a little bit about expectations for the Fed, how that fits into your process and what you're seeing with the market, again, risk assets so resilient here?
Yeah. I mean, if you go back to kind of first principles about why the Fed changes interest rates, they've got their mandate of full employment and price stability. And so to believe that interest rates are going to get reduced, or, to make a case for it, you'd need to see inflation coming down.
Sure.
And expect inflation to go lower. You expect employment to kind of go off the rails, or, to be showing a clear trend of deterioration. So I don't see any evidence, like currently, and maybe I'm looking at the wrong data, there doesn't seem to be a clear case to be made for that, unless you do that inflation's going to go lower, or that the economy, there's the potential of some kind of crisis kicking off. So, I think, like, and there has been times where they do take precautionary measures, like, I mean, March 2020 was kind of the key example of that. They took an extremely aggressive precautionary approach. They wanted to take the risk of doing too much than too little. And so, to to believe that interest rates should go low, you have to believe that the data justifies it. Or, I mean, I was thinking about it too. Like, if you really wanted to get rate cuts, maybe you could change the mandate.
Right.
Maybe you make it, you increase the inflation target, or you say the currency's now an objective to get the currency lower, or you say, rather than just consumer price stability, we want housing market price stability. So therefore, we want house prices to go up in a range between 1% and 5% or something like this.
Yeah.
So you'd have to change the mandate, or you'd have to change the interpretation of the mandate to say, well, price stability requires that we take a more aggressive approach to, offset deflationary AI headwinds or something like this. I mean, you can get there, and maybe you say, well, 25 bips, 50 bips, maybe you can make a case for that, and it's not really going to make a difference. But yeah, I think getting to a rate cut is, unless I'm missing something kind of hard to get there.
Yeah.
Getting to a rate hike, well, if you look at where inflation expectations are, if you think about the economy is actually resilient, it's like, unless it does go off the cliff. And if you think about fiscal stimulus, maybe a little bit of tariff upside risk, commodities, in my view, look bullish, so that's also upside risk. And then also just psychologically, everybody's sitting there. We've just had this inflation shock, so if inflation does start to come up a little bit, then we kind of run that pattern again and start negotiating up prices. It's normal. It's kind of what we expect now because of the recency bias. So I think inflation upside risk, resurgence risk is very credible, not just US but globally. So and how do you tie all that back to markets? I mean, I don't think that the markets are actually, as you said, pricing in much in terms of cuts.
Yeah.
I don't think that, that the current rally is, reliant on Fed stimulus. So, to that end, being, disappointed by that, maybe it doesn't matter. But if you get inflation resurgence, then that opens up a few different paths that we have to think about, like, the inflation-related assets like commodities are going to do well. And commodities are cheap at the moment. So that's one thing I talked about in the latest week in the chart storm is, if you look at stocks, are expensive. Bonds, we already talked about that. They're cheap, but, bonds need a recession to be good. Commodities are also cheap. They're actually just as cheap as bonds, and they kind of protect against the opposite end of the spectrum of,
That's right.
of runaway growth and inflation. So, I think that, and that's the thing. It kind of highlights two things. It's like, one, you can get caught up in all this opportunities there, and even when you talk about risks and things, there's also risk and return are investing 101 are two sides of the same coin. So one thing's going down, another thing's going to go up.
That's right. It's so, I mean, there's some really good points in there, Callum. You mentioned the Fed's mandate changing. I mean, I'm sure, as you've probably noticed, the political situation in the U.S. right now is a total nightmare, probably in a lot of ways. And hopefully the Fed's mandate is not changing, but we'll see.
Yeah, that's an interesting point, though, too. Like, from a political strategy, it like, if you're an economist, you're sitting there thinking, oh, this is bad because it's it's impacting on Fed independence and it's not good, and blah blah blah.
Yeah.
But then from a political, I can understand why he would take that angle, because if the economy goes down, it's the Fed's fault, and then if inflation or if the economy goes up, markets go up. That's I did that. And if inflation goes up, that's the Fed's fault.
That is political science 101 in America, right there, Callum.
It's also option profiles, right?
That's true.
That's kind of strategy 101.
Yeah, that's right. Very, very, very similar.
Yeah,
Hey, we're almost
yeah.
out of time. This has been awesome, Callum. I
Mm,
really appreciate your insights. I'd love to ask you about one other chart that you had. I think this was in your most recent weekly chart storm. You talked about VIX seasonality, and we've been
mm,
talking a lot in my work about the volatility. I mean, the VIX remains at extremely low levels, kind of around 15 a handle here at the end of July. Can you
mm,
talk to us a little bit about the seasonality in the VIX, certainly the seasonality in the markets? How does that
yeah.
relate to some of the comments we've been making earlier about of course, risk assets that have been so strong to date?
Mm. Yeah, well, and before we jump into that too, I also put a chart, similar chart in Monday's report, which showed basically the exact same thing for credit spreads,
Yes,
and credit
yes, I
spreads
saw that
and
one too.
fixed
Yeah,
income. Yeah, so yeah, well, it's sort of around this time of the year that you do have this seasonal tendency for volatility to kind of drift higher, credit spreads to be elevated, stocks to kind of stumble. Um, and I mean, the way I think about seasonality is that it's kind of one of those. It's either prompting information, so it's like, oh,
mm,
let's go and take a closer look at this because this is it's telling us that something might happen, or it's confirming information. So I've already got a case, and seasonality happens to line up with it, so that's good,
yeah,
more conviction. In this case, if we think about it from a prompting standpoint, it's saying, okay, there's a risk that volatility is going to go up. What does that really mean? That means that the stocks go down, basically, or that something kind of happens that we weren't expecting. Um, and then if you think about stocks are expensive. Sentiment is still climbing its way back up. It's almost there in terms of being, at frothy levels again.
yeah,
Um, and then, if you look at the risk backdrop, there's geopolitics. Well, there's a little bit of stuff going on there. Policy uncertainty. Well, the trade war stuff's kind of still being tinkered with,
sure.
um, but seems to have quieted down. Inflation, nobody's thinking about that really. So that could be one of the things to think about, or something around the Fed surprise. Um, I mean, I don't think that they would come out and just hike rates. That would kind of be, that would be extremely unexpected.
Yeah,
But then, the other thing is that um, when you have and I often talk about this with valuation setups, is that, the market might be very, very expensive or very, very cheap, especially when it's very expensive. Um, the thing that makes it kind of unravel in the end, sometimes it's actually quite hard to think about, the story or the narrative about what that's actually going to be. And so, we can try and think about what story to tell and what thing it's going to be, but that's, I guess, the nature of risk, and especially volatility, is that it might be something that we haven't even thought of yet, that ends up being the catalyst or the trigger.
yeah. No, that's a great point. I feel like that we always hope that
Maybe we
risks
should pay a bit more
are things we
attention.
can totally define, but a lot of times it's what we
Mm,
don't know yet, right? We don't know what we don't know, I guess, at this particular moment, right?
mm, yeah.
Callum, this was a lot of fun. I mean, I really appreciate your insights. And I'm often asked if I consider myself a macro strategist. And I say, no, I'm a technical
Mm.
analyst, but I follow some macro guys who are really good. And one of the ones that immediately come to mind are you, Callum, and your work at Top Down Charts. Where can we point people to find more about your weekly chart storm and other work that you're doing?
Yep. So the weekly chart storm, it's sort of a rundown on the US stock market every week. I put that out on Sunday mornings my time, which is about, I think, Saturday afternoon your time.
Yeah.
So that's a good US stock market focused. If you're interested in that, just look up Chartstorm. And then the top down stuff, as I sort of mentioned, is more multi-asset, big picture stuff. Again, look out top down charts. There's something for people that want a lighter version, and then there's the institutional service of that. So yeah, a little bit for everyone there.
That's fantastic. Callum, my 9-year-old son, as I told you before we started, was super excited. I was talking to someone from the future. So thanks for joining me from across the international date line from New Zealand. Great to get to know you. Great to hear a little bit more about some of the techniques and tools that you're using. And I hope we can talk again as we gather more evidence together. But thanks again for coming on the show today.
Yep, my pleasure.
It was a fun conversation with Callum, and apologies if there were some internet glitches in there. We tried to clean. We had a really glitchy interview when we were doing it virtually, and we kind of joked a couple times, like the fact that I'm interviewing him from out in the woods, in the greater Seattle area, and he's basically in the southern island of New Zealand. We're a day apart. And across an ocean. The fact that we're able to have any sort of conversation is a modern miracle. Hopefully, my editor was able to piece together a pretty good experience for all of you. But technical glitches aside, I really appreciated Callum's take on things. I'd encourage you to check out his work. He has a Substack email that you can subscribe to. Top-down charts is what you want to look for. But I really like how he applies best practices of technical analysis to macro data, right? Thinking about valuations, thinking about inflation, thinking about volatility, liquidity, all using, concepts from technical analysis. That's what I really love about his work. It's very visual, right? I think a lot of macroeconomic discussion can get kind of dry and kind of wordy, and I love how Callum focuses on the visuals. He focuses on the visual representation of this data and using that as a foundation for his perspective, which certainly resonates with me. Really loved his comments about combining valuations and the quote that I'd pulled from one of his recent reports, which I asked him about. Valuations, even extremes, are not enough by themselves to get max bearish on stocks versus bonds, because as he described, right, that stock to bond ratio, that stock to bond, allocation is arguably one of the main decisions you need to make as an investor. To get max bearish on stocks versus bonds, you need technicals to turn, and you also need bad macro. And he observed neither of those conditions in his own work, and I would generally agree. So we often complain or get nervous about high valuations in bull markets. Market history is full of bull markets that have been driven by valuations feeling way overvalued or higher than normal, because we're going up and gaining a lot of ground on the upside. Great reminder to think about valuations, technicals, macro, all as three different pieces, and seeing if you see some weakness in the other two. Loved his take on credit spreads. Big fan of that. Interesting take on the Fed, to be honest with you. I don't think, rate hikes are on the table. I think what Callum and I kind of hinted out, there's a political pressure right now in the U.S. for the Fed to start lowering rates. I don't know if that will eventually move the needle, but certainly seems like the market is pricing in rate cuts here, most likely at the September meeting. Great interview with Callum. Thanks again, Callum Thomas of Top Down Charts, joining us from New Zealand for an interesting conversation. I hope I can circle him back in as we gather more data. Maybe as we get through that seasonal period of August and September, it would be fun to reconnect with him. Would love to hear any other suggestions you have. This came from one of you months ago, suggested catching up with Callum, and I'm so glad that I did. Please keep the ideas coming. If there's anyone that you've heard on another podcast, you've seen them on TV, you follow their work, you've read their book, and you think it would be interesting to hear them answer some hopefully very great, thoughtful, insightful questions from me, please let me know. Just drop a comment wherever you're hearing the podcast. By the way, if you want to learn more about the technical tools and techniques you can use to build a successful routine as an investor to improve your market awareness and make better entry and exit decisions, our Market Misbehavior Premium memberships may be a perfect opportunity for you to upgrade your own process. 3 great benefits to the premium membership. First off, you have access to our virtual courses like Flight School Behavioral Investing, where we teach you all about behavioral biases, what happens between your ears, and technical analysis, a practical set of tools to evaluate market conditions. Also, another course we have called Market Misbehavior on Demand, where we actually have all of our previous webcasts stored and available. So we have market top checklists, market bottom checklists, deep dives into different technical indicators, sentiment, etc. You have access to all of that as a premium member. Second benefit, you will be able to get our members-only reports like our weekly flight plan which is our main report where we focus on what we learned in the week that just happened. We look forward at the week to come, identify some key levels, patterns, and signals we'll be watching for. Also, our monthly chart review where we apply our proprietary market trend model to a series of ETFs and asset classes. Finally, you will have full and immediate access to our members-only community where you can ask questions, share charts, see how other investors, like-minded investors, are approaching these markets. I'm in there every day sharing ideas, answering questions, and helping our premium members navigate these markets. I love doing that with a smaller group of motivated investors. So if that describes you, go to marketmisbehavior.com/premium where you can learn all the information you need. By the way, don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. That's at marketmisbehavior.com/premium. That'll do it for today. I'm Dave Keller with Market Misbehavior. Thanks so much for joining me here today on the podcast. Reminding you as well, it's always a good time to own good charts.